Chapter 18 is about globalization and both the benefits and costs of having a more integrated world. And we're going to look both sort of at growth, the benefits and costs for workers, for capitalists, etc. So there are obviously a lot of pros and cons, and certainly uh, the world has become more globalized over the last 40 years. And what we want to think about is as we trade more goods and services, as people move across national boundaries, and as capital moves across national boundaries, uh, what do we think about that in terms of, is it good for workers? Can governments influence the trade? Um, who benefits? Who loses? And is it overall a good thing for everybody involved? So if we look at globalization, what we really mean by globalization is the increase in flow both of goods, right? So trade, uh, investment, so capital, and labor, right? And so labor can sort of flow a number of ways. One way is just immigration, right? So people can move from one country to another, but also production can move to different countries. And so here's a graph of employees at Ford Motor Company, and you can see that while the United States still has more employees than other countries, there are a lot of employees in China, Brazil, Germany, and around the world. And so one of the questions that we're going to ask is what's the effect of offshoring, right? When a company decides, okay, I don't want to produce in this country anymore, I want to go produce it somewhere else where there is some other benefit, often cheaper labor. So we're going to use our models to try to understand really the flow of three different economic factors of production, right? So goods and services, so we'll call that trade. International capital markets, so the flow of savings and investments. So we'll talk about foreign direct investment. We'll talk about when capital sort of moves and how countries can sometimes control the flow of capital. And then we'll also talk about migration, right? The move of workers from one country to the other. And governments have traditionally done things both to encourage globalization and to discourage globalization. And so some of the things that they've done to reduce globalization include putting tariffs on goods and services. So that's like a tax on imported goods. If we put an tariff on steel imported from other countries, then uh, imports of steel become more expensive. That helps our steel producers, but it means that the people who buy steel in this country have to pay more. We've had immigration policies. So the United States, of course, has always been a country of immigrants, but starting in the late 19th century, we started putting different restrictions on who could move to the country. Capital controls. So this is sometimes harder, but it's the idea that you try to limit the ability of individuals or firms to move their financial assets. All right. So if you can limit movement of bank accounts, of stocks and bonds, all of that stuff across national boundaries. And then also monetary policy. So monetary policy is important to remember because it can affect the exchange rate. And so if the interest rates are the same and you lower one, then that's going to affect the exchange rate because people will not want to buy those bonds as much. And so that can be an important factor as well. So we're going to start off just talking about the integration of goods markets. So this is going back to 1820, and this graph shows the percent of world GDP that is exported. And so you can see back in 1820 it's very low. It's about 2%, 1 or 2%. And it increased steadily up until the Great Depression when it was about 8 or 9%. Following the Great Depression, countries put a lot of trade restrictions on, and of course World War II made trade more difficult as well. And so trade decreased throughout the 30s and throughout World War II, and then started to increase again. And we saw a pretty steady increase during the 50s and 60s, and then a really big increase in the 1990s and first part of the 2000s. And so a number of things were going on there. One was the collapse of the Soviet Union, and so there was more trade with Russia. and another was reforms made in China so that they became a more capitalist country and opened themselves up to trade. And they were admitted to the World Trade Organization in 2000, and trade between China and the rest of the world really took off after that. And so you can see we're going to sort of, if we think about it, there's an increase in trade, a retraction, and then another increase in trade. And you can see now about a quarter, a little over a quarter of GDP is traded. So that's a big increase from where it was. And we want to think about, is this a good thing or a bad thing, or both? Who's benefiting and who's not? So if we think about the way that goods markets have become more integrated, we need to think about the law of one price, right? And so if there are no transportation costs, then the price should be the same in different countries. But of course, there are going to be transportation costs. But some of those transportation costs have really shrunk over the last 100 years, right? So things like shipping, trains, uh, planes, all of those things have reduced the cost of trade, which means that the price in the exporting country and the importing country can be much closer. And so the trade gaps have really shrunk, say, from 100 years ago to today. And if there's some level of arbitrage, meaning that, if a good is more expensive in the United States and cheaper in Mexico, then there is an incentive for someone to go buy it in Mexico, bring it to the United States, and sell it there. And so as long as those arbitrage opportunities are working, then we should see prices start to converge. And so we can see this. This looks at the difference between prices uh, between the United States and the UK. And so a negative value here means that the US has a lower price than the UK. A positive value means the US price is higher. And you can see, so the red lines are 1870, the blue lines are 1895, and the green lines are 1913. This is that first wave of globalization. And you can see that for most products, the difference between the prices got smaller, right? So by 1913, and all the products here, wheat, meat, cotton, iron, cotton, sorry, this was cotton textiles, this is just cotton, copper, everything except for sugar, the price difference got much smaller. And so sugar, there was a bunch of things going on. Um, Part of that was the UK had colonies in the West Indies, and so they had access to a lot of sugar that the US did not. Here you can also see the price gap for wheat and then the British imports of wheat. So as the price gap got smaller and smaller, Britain imported more and more wheat. And so what we've seen over the last 100 years is those price gaps getting smaller and smaller, and because of that, trade increasing, right? So that's a positive cycle there. And so if we can really think of sort of two trends of globalization, as we talked about before, the first one was in the second half of the 19th century up until about 1914 when World War I began. And then the second one was after the end of World War II. The deglobalization happened during the Great Depression, and a lot of that had to do with tariffs and quotas that countries were saying, well, our economy is doing really badly, so we want to try to protect it. Unfortunately, that often had the opposite effect because whenever you try to help your production firms, then you're also going to hurt your exporting firms because other countries are going to put tariffs and quotas on the things that you export. But what we've seen over the last 35 years is that both in low and middle income countries, which is this blue line, and in the high income countries, which is this red line, tariffs have decreased. And so tariffs on goods and services have decreased from about 35% in the low and middle income countries to about 10%, and from about 9% in the high income countries to about 4%. And so a lot of the trade agreements, you might have heard of, the General Agreement on Trade and Tariffs, the World Trade Organization. There have been a number of trade agreements that have reduced these tariffs with the goal of trying to increase trade. And so what we want to think about as we go forward in this chapter is who has benefited from that increased trade and who has not benefited.